Hello everyone, thanks for joining today. My name is Fijai HDZ and in this season I will be presentation our study title Determinants of Financial and Sustainable Growth Rate and Empirical Study in Emerging Market. The focus of this research is to analyze the factor that impact financial performance and sustainable growth rates within emerging market. As many of you know, emerging markets are unique in their dynamic growth potential and complex economic environments, which present both challenge and opportunity for company. In today's presentation, I will cover the research background, methodology, key finding, and implication of our study. I hope this session will offer valuable perspective on how companies in emerging markets can strategies for sustainable growth and financial resilience. Let's begin by exploring the context and motivation behind the research. The next slide, introduction. The phenomena of fluctuation in the sustainable growth rate value continue to increase and also decrease. The large decline in a company's financial performance was in 2020 due to COVID-19. This situation has caused uncertainty in various industrial sectors in Indonesia, which has resulted in decreased demand, suppression of the supply chain, and increased opportunity cost. The impact of the decline in SGR is that many companies have gone bankrupt, especially for companies that have been opportunistic with the low profit margins. In this situation, companies must be able to face the challenge of maintaining sustainable growth amidst the global crisis. Okay, next slide. Manufacturing company PT Indokorsa Tbk or BRIM experienced a decline in financial performance, namely of 47.69% decrease in net profit to 68 billion rupiah. BRIM's revenue fell 21.2% to 979 billion annually. PT Unilever Indonesia experienced a decrease in net profit and a decrease in overall sales. Unilever net profit fell 0.5% to 4.8 trillion rupiah from 5.36 trillion rupiah in the previous years. This decline was due to declining revenue but was not offset by the efficiency of the cost of development, but is more focused on being as defined distribution. Okay, next slide, research purpose. The research conduct aims to understand how profitability affects financial performance, how liquidity affects financial performance, how company size affects financial performance, and how financial performance affects sustainable growth rate SGR. Research on SGR is important because it will help a company understand the level of sustainable growth that is balanced without experience financial problem. With this research, it provides a deeper understanding to all company stakeholders about how company can increase sustainable growth in emerging markets. Next slide, theoretical review. The theory used in this study is stakeholder theory. Stakeholder theory explains the relationship between a company and other parties who have an interest in its activity and success because a company cannot remove itself from the surrounding and social environment. Stakeholder theory is theory related to how a company communicates with parties who have an interest in the company. Stakeholders are individuals or substances who have economic or not economic interests. Stakeholders are very important because they are related to the sustainable of a company. The next slide, research method. The population used is manufacturing company listed on the Indonesia Stock Exchange or IDX and have published financial report for the 2019 until 2023 period, and there is information of profitability and financial performance. The sample obtained were 4,083 company in 2019, 2020, 2021, 2023, so that the number of sample was 1,478 x 5 period totaling 2,355 sample. The sampling technique used was purposive sampling by selecting samples based on several criteria, namely 1. All Indonesia company list on the IDX in 2019 until 2023, 2. Companies that have published financial report continuously from 2019 until 2023, 3. Companies that have financial ratios or to measure the variable used in the study.
Result and discussion. The result of the first hypothesis test show that profitability has an effect on financial performance, while liquidity and company size do not have an effect on financial performance. The result of the second hypothesis that show the financial performance has an effect on SGR. The measure of profitability on financial performance. The results show that profitability X1 has a positive and significant effect on financial performance with a test statistic of 23.481 and a significant value of 0.000 less than 0.05. So this hypothesis is supported. This positive efficiency means that the higher the company profitability, the better the financial performance achieved. Like profitability support indicates operational efficiency and the ability to generate profit. They have also to depend on financial performance. Liquidity X2 does not have a significant effect of financial performance with a test statistic of 1.358 and a significant value of 0.175 more. That's 0.05. So this hypothesis is not supported. With the threshold, no significant relationship was formed between liquidity and financial performance. Liquidity is related to the problem of a company's ability to meet its financial obligation that moves the debt immediately. The amount of liquidity asset owned by a company at a certain time is the company paying power. The impact of companies on financial performance. Companies X3 does not have a significant effect on financial performance with a test statistic of 0.744 and significant value of 0.457 more than 0.05. So this hypothesis is not supported. The result indicates the company says is not significantly related to financial performance. The means that the higher the company says, the higher its financial performance. The influence of financial performance on sustainable growth rate. Financial performance has a positive and significant influence on sustainable growth rate, with a statistic of 16.25 and a significant of 0.00 less than 0.05. So this hypothesis is supported. This means that the companies with better financial performance will have a higher sustainable growth rate because they have a strong financial capacity of support growth. Conclusion. Based on the result of this study, I can be concluded that profitability has a positive and significant effect on financial performance and SGR. This meant that high profitability can support increased operational efficiency and the ability to generate profit. Liquidity does not have a significant effect on financial performance. This indicates that the occurs because the increase in current asset owned by the company is greater than the current liability. Company size does not have a significant effect on financial performance. This means that the higher the size of the company, the higher its financial performance is not necessarily. Financial performance has a positive and significant effect on sustainable growth rate (XGR). This means that companies with better financial performance will have a higher sustainable growth rate because they have a strong financial capacity to support growth.